Morning, everyone. Well, thanks, Andrew, for the intro. When I signed up to Howthworth, I didn't think I was going to be involved in a selfie. And if it goes viral, it could be known as a new selfie Brexit or Brexit selfie. So let's see how that goes. Also, thanks to Mike for helping me settle in and for the handover process. He's into it. Yeah. Mike, can I just ask, have you got your briefcase with you?
Not on my person.
Right. Well, well, the budget for the second budget after the election, there was quite a lot in it, and it's still being debated now. A summary of it, some of the main changes are in your packs, and what I'm going to do over the next 20 minutes or so is to just highlight a few key issues. I'm going to start off actually with what's on page 11, which is capital gains tax. For the first time since 2010-11, the annual exemption is staying the same at 11,100. Now, the planning here is that if you're due to sell your assets or shares, is to transfer a holding to your spouse to make use of the annual exemption, because every UK taxpayer has one. Now, I have been warned by the partners that there are some left field questions, and I'm going to preempt two of them. We are in the 21st century, so spouses does include husband, wife, and civil partners. We are not in Salt Lake City or Utah, so if you're a Mormon and you want to use up your multiple annual exemptions, you can't marry many times and transfer. Believe me, I was asked that question when I was up in Preston. There's a Mormon church, and I can't believe I got asked it. All right? The next change, which is a welcome change, is the exit rates for capital gains tax. These are nearly being halved from 28% down to 20% for high rate taxpayers and 18% down to 10%. He's brought in a new 10% rate for external investors. This is to widen the scope of entrepreneurs' relief. At the moment, for you to get this 10% rate, you have to be an employee or director, hold 5% of the shares, and hold them for 12 months. This new rule, which comes in from 17th of March, is that you don't have to be a director or employee, but the condition is that you need to hold the shares for 3 years. The rule on whether it's going to be less than 5% is not clear yet, but I'm assuming it is, because if you're a 5% shareholder, you would want to be a director anyway. So I think it's more aimed at lower shareholdings, but without being an employee. They've also brought in a new 10 million limit for capital gains tax entrepreneurs relief. Before, if you sold for 10 million or sold for over 10 million, anything above that would have been taxed at 20%. Going forward, if you buy shares and you're not an employee, you've got another 10 million rate. So, if you're like Richard Branson, who's a serial entrepreneur, if you sell your stake in your business for £10 million, you pay tax at 10 million. You join Dragon's Den, you take a small stake in a trading company, and if you sell that for another 10 million, you still pay tax at 10%. So all of a sudden, you've got £20 million worth of gains taxed at 10%. And here he is, talking about Richard Branson. I didn't know that was coming up. Now, for the first time in my 20-year history in tax, it's the first time that the revenue or the government have brought in retrospective legislation that could be a benefit to taxpayers. They brought in measures in Finance Act March 15 to stop entrepreneurs' relief being available on certain transactions. One being the sale of goodwill to yourself on incorporation. Secondly, they questioned the fact that do you have trading status if your only investment was in a joint venture or a partnership? They said no back then. And if you sold to your family member and then sold a building outside the company, you didn't get it. But they thought the law was too drastic, and they've gone back and have told the clients that you've paid too much tax. So if you've got transactions in this area, it may be worthwhile having a look back and saying, why didn't I get entrepreneurs relief? Is it worth me going back and claiming my tax back. First time ever, I've not known it. Whether he'll do that again, I don't know. Normally he goes back to collect tax, not to pay it back. Homes under the hammer. Now, there's been a lot in the press about residential properties and buy-to-lets. And in this budget, homes are still being hammered. There's been a boom in this area over the last 15 years. But George Osborne still wants to take his slice of this growing sector. Firstly, looking at residential property, talk about the 3% surcharge, whether that was going to come in or not for large investors and companies. Well, that has been confirmed. Additional properties will be taxed at 3%. If you're a large investor with more than 15 properties, you still will have to pay 3%. If you're a company buying buy-to-let properties, you will be taxed at 3%, the additional 3%. What he has brought in is this 36-month grace period. If you're in a situation where you own your own home, but in the process of buying a new one or already bought it, you've got 36 months to sell your old house, and then you will get your stamp duty back. You'll have to pay the stamp duty up front, but by the time you've sold your house within 36 months, you'll get your stamp duty back. I don't think it's going to be an automatic payback, so you have to instruct your solicitors to make that claim for you. Planning around this, it comes in effect from April, so the only thing to do is to try and complete by the 31st of March. I know we've got some estate agents in the room and some solicitors, so it'd be interesting to see whether there's been a rush on conveyancing in the last 2 to 3 weeks. We've got a few nods there, so they are trying to make use of that planning pre-April. One thing that was mentioned in the last summer budget was the removal of the wear and tear allowance. At the moment, you would have got 10% annual relief for what you purchased historically, a furnished property, 10% of the rent. Going forward, the revenue, have scrapped that, so you can only get tax relief on actual purchases. So if you're replacing washing machines, fridges, you'll get tax relief for the purchase cost. Historically, if you bought it 10 years ago, you're still getting 10% of the rent as a tax deduction. So he's taking that away from buy-to-let landlords. Well known is that the interest rate restriction being phased in from April 17. And by April 2020, you will only get a 20% basic rate tax deduction. What I mean he's hammering buy-to-let investors is that although the capital gains tax rate has been reduced, you won't get the 20% rate if you sell a property as an individual or a partnership. It only applies to companies. So if you own residential properties through a company and sell the shares, you will get 20% or 10%, but not as an individual. The interest rate restriction doesn't apply if you hold properties in a company and borrow within a company. So, what it seems like everything's gearing towards incorporation. Looking at commercial property, some changes here. He's moved from the slab system to the slice system to be aligned with residential properties. What I mean by slab is that if you're a pound over, say, 250k, all of it's taxed at 5%. Now it's a slice system, so that the first 150 is at 0, the next 250 is at 2, and the above is at 5%. He mentioned in his budget speech that if you buy a property for 270,000, you'll be better off. Well, calculations show that anything up to 1.05 million, you are better off under this new system. But anything above that, you actually be worse off with the higher rates. They expect another 500 million in additional stamp duty revenues from the changes. It comes in effect from 17th of March. If you've exchanged before that, you can either decide whether you use the slab system or the slice system. No-brainer, really. If you're around the below 1.5 million, choose to slice. Choose a slab, sorry. I've always mentioned about capital gains tax being reduced, but he's made some changes to corporation tax. This is reducing faster than originally planned, coming down to 17% in 2020. Now, he did say it was a budget for the working people, And he must think that the working people are going to make losses early. He's probably right. So he's made the use of brought forward losses more flexible. From 1st of April 2017, losses are now available to be offset against any profits. Before that, you could only set it against the same trade. So if you're in a situation where you've got some rental profits and some trading profits, going forward, these losses can be used against everything. At the moment, we've got a situation whereby a company's got major trading losses brought forward, got some small rental profits, but still paying tax. Clients couldn't really believe, I've got all these losses, but why can't I use them? Rules are, it's the same trade, not rental profits. But now, from April 17, you can use them. In a group situation as well, if you had losses in one company, they stuck with that one company. Carrying forward, you can carry forward losses and leave it around the group. So it's a lot more flexible from April 17. Some restrictions, if you're above £5 million worth of taxable profits, only half the amount above 5 million can be used with the brought forward losses. He doesn't like banks. I know they've got a few bankers around here, and it was a restriction. He's restricted it further, that only 25% of losses for banks can be carried forward. Now, he's reduced corporation tax rates and he's allowed losses to be used more flexibly. That means you should be paying less corporation tax with more money to draw out for yourself. What he gives, he takes away. We all know that dividend tax is going up from April 16. Look at the numbers, it's all going up by 7.5%. And this applies from 6th of April. At the moment, the rates can still be used. And there's planning opportunities now, up until the end of April, to the 6th of April, for you to vote a bonus to make use of the lower rates of dividend tax. Even with corporation tax going down, it's still better to take a dividend rather than salary at all levels because of the NIC savings and also because the corporation tax relief on salaries and NIC is coming down from 19 down to 17. So dividends are still the better route. Another way to get cash out of the business is by borrowing from your company. Obviously, banks don't like that, but you can borrow from your business. It's not free. You've got to pay tax on it. The company's got to pay tax on it. At the moment, it's at 25%. From April 16, if you borrow from your company, it's going up to 32.5%. So he's put that up by 7.5%, thinking that's what business owners will do, given the new tax rates going up for dividends. Keep your mind on drawing cash out of the business because after April 16, he's closed another planning tool. Before April 16, what you could do was draw money out of your business, build up a loan account. Yeah, you pay your 25% tax, the company pays the 25% tax. But what you do then is when you come towards the end, you would close the company down via a members' voluntary liquidation. And then the loan account will be repaid via proceeds on liquidation. So the company gets its 25% tax back from the revenue. You get your proceeds, you pay for your loan account, but you get taxed at 10% on those proceeds if you're a trading company, or 28% if you're a non-trading company. Sounds great. What's the position after April 16? Well, obviously the cash cost is a lot more. It's 32.5% rather than 25%. But you know, still, that's a cash flow cost. When you close a company down and repay your loan account, the company's going to get that back. So, on liquidation, your proceeds are now going to be taxed at 20% for an investment company and still be at 10% for a trading company. So, although the annual cash cost is more, the exit cost is a lot lower. Too good to be true? Yep. From April 16, if you do that, you cannot reinvest those proceeds in a similar activity or trade within 2 years of your liquidation. If you do that, the revenue say, no, that wasn't for bona fide commercial reasons. It's a way for you to get money out at a reduced rate of tax. So you'll be taxed on proceeds as a dividend going up to 38.1%. So he's closed that planning. But if it's a pure exit and you do want to retire from the business, then it's worth using this route as a means of getting cash out. A budget for farmers. Completely out of the blue, but a quarter of our client base are the farming community, and we've got some tables here. It's headed up by Richard and Suzanne, and I needed to get farmers in to bring them back in the room. Okay. One thing that has changed, everyone can relax for a minute for this one bit, is the 5-year averaging. It was 2, now it's 5 years. For those who think what's all this averaging about, farmers are prone to major fluctuations in profits due to crop disease, weather, floods. So their profits go up and down, and they can't manage their cash flow, or it's very hard to manage their cash flow. It could be huge one year, low the next year. Going forward, the revenue have allowed it to be averaged over 5 years, which should equal things out, which should help the cash flow. So that's the farmers. Okay? The other points apply to farmers as well as all other businesses. The fuel duty freezes, that should help on cost savings, on running costs. Stamp duty savings on commercial property. Again, anything below 1.5 million, you're going to make stamp duty savings. Selling your farms for 20% or 10%, that's going to help with the exit and moving on to the next generation. There's this trivial benefits exemption. Anything up to £50 can be given to employees tax-free, so you don't have to worry about PLMDs, dispensations. These things such as with Easter coming up, Easter hampers, Christmas gifts. Employment allowance, now that's going up from 2,000 to 3,000 from April 16. So make sure you're registered on the payroll. If you've got any issues, our payroll team can make sure that you are covered and you are getting all your reliefs. You've got the tax rates reducing if you're a company. That's going to help. And business rates relief as well. That's going to apply to farming properties as well. So all these should help reduce your costs to help you pay tax on your good year profits. So that's the farmers looked after. Now, when I looked at the budget, it's what's the feeling I'm getting? Is the UK heading for a corporate UK? Is George Osborne gearing us towards becoming limited companies? If you looked at the changes, let's compare the two. I mean, business rates, yes, they apply to both. Employment allowance, yeah, applies to both sole traders and limited companies, but in a limited company, if you're a sole trader, if you're a sole shareholder, director, employee, you won't get your 3,000 allowance. Personal allowances, individuals 11.5. You take cash out as a dividend out of the company, you got your 11.5, but you also got a 5,000 dividend allowance from April 16. Class 4, you don't have to pay as a shareholder and taking out dividends. Trade losses, for brought forward trade losses for sole trader, I think they're still restricted. Devil's in the detail in the draft legislation, but for now, I think you're still restricted. In a company, a lot more flexible going forward. Tax rates, 20, 40, 45, compared to, in the future, 17, and the top rate of tax, 38. CGT, especially for rental businesses, if you incorporate a rental business and sell it, you're paying tax at 20%. If you sell a rental business as an individual, 28%. Interest rate restrictions, nothing for companies. Individual landlords, yes. So it looks like you are gearing up towards a corporate UK. What I think he's doing is that he's giving himself some flexibility going forward. Bring everyone into the corporate net, especially buy-to-let investment companies. And he may follow the Irish system, whereby they have a 12.5% rate of corporation tax, but they charge 25% on rental profits. It gives them that flexibility depending on maybe what happens with Brexit. But overall, there was a lot in that budget for tax planning. He said it was a budget for the next generation. He's made it a lot easier to sell to the next generation and move on. few planning tools closed, but there's still a lot there to look at with dividends, cash extraction. So really, it's a case of planning to make sure that retain your wealth for your own next generation. And that concludes me. I hope that's been informative.